This is your LMAX Exchange technical update for Monday, July 24th, 2017. Eurodollar. So on a medium to longer term basis, technicals are getting interesting with the euro because if you look at this chart going back to 2015, the market has been range trading with that high defined by the 2015 peak at 117.15. And so if the market can establish above that level, it would suggest that we are seeing a major base and could open the door for significant upside again over the medium to longer term. Short term, we've seen a very impressive rally in 2017 out from multi-year lows down in the 103s, and daily studies now into this range are looking very extended into this range resistance, which does suggest that even if we do take out 117.15 in the sessions ahead, the market will have a hard time establishing above it, at least on this turn and this try above 117.15. And so there is risk building for some form of a short-term corrective pullback before the market even considers a meaningful break above 117.15. But right now, key support for this market comes in below that range, that low that we had seen in the previous week around 114.35, and a breakdown back below that level would really do a good job of taking the pressure off the top side and opening the door for a more significant corrective decline. Until then, any setbacks are viewed as minor corrections ahead of what could be that breakout above 117.15. Sterling dollar. So for cable, it's a story of consolidation, choppy consolidation. The market has recently pulled back after putting in a 2017 high in the previous week above 131, but it wasn't able to really sustain gains up towards and above 131 with the market pulling back below 130. It's shown that since the past several weeks, since breaking out initially above 130, going back to the month of May, it hasn't been able to hold above 130, and so we could still see a period of this choppy consolidation before the market heads back up through 31.26 and towards what is now a medium-term measured move extension at 135. This follows the breakout that we saw in April above that range high that had defined the top of a range off the plus 30-year low from October of 2016 at 118.40, and so a conservative measured move following that consolidation takes us up towards 135. But again, on a short-term basis, it's unclear that the market wants to sustain gains towards 135 right now, and we could still see choppy consolidation roughly between 125 and 130 before the market pushes higher. Of course, if we do break back above 131.26, it will suggest that we are going to see a more immediate test towards 135, but until then, there is risk that we see potentially some pullbacks in favor of additional consolidation before the market pushes up. Any setbacks, therefore, should be very well supported and should be used as opportunities to buy into these extended declines down towards the 125 area. Dollar yen. So dollar yen has been trading lower since topping out by range resistance in this market up in the 114s. The market has been adhering to this range trade over the past several weeks for much of 2015, and so the risk from here is building for continued declines back towards a retest of the 2017 low, which comes in just shy of 108. We would need to see now a break back above the recent highs in the 114s to take the immediate pressure off the downside. Euro Swiss. So Euro Swiss continues to consolidate now above 110. This consolidation is a bullish consolidation, and following that break above the key psychological barrier has set the stage for the next major upside extension in this market to retest critical resistance in the form of that 2016 high at 112. Only back below recent support in this market around the 109.80 area would take the immediate pressure off the top side. Aussie dollar. So Aussie has extended its 2017 run with this market trading all the way up towards a critical psychological barrier at 80, and this market now could be poised to continue its gains towards next key resistance, which comes in at 81.63 further up. Daily studies here are, however, extended, and so there is risk for a short-term corrective pullback before the market looks to break higher and potentially signal a structural shift and major base down here off the lows that we've seen over the past couple of years, those lows that go back to 2015 down all the way down below 70. And so the question right now is this market putting in a major structural shift which could favor upside well beyond the 80 handle, or are we seeing the market putting in a false break up here, an adherence to what could be a more consolidation before the market considers its next big move? The breakout that we have seen above 78 leans towards the bullish structural shift side, but again, daily studies here are quite extended, and so we could see a short-term pullback at the minimum over the coming sessions. Dollar CAD. So dollar CAD continues to extend its run of 2017 lows, with the market breaking down thus far towards 125. You can see here that the market is now closing in on a retest of the 2016 low at 24.61, which could be seen over the coming sessions. Daily studies here are, however, very extended, which does warn of the possibility for a near-term correction to the top side. But right now, we need to see this market break back above 127 at a minimum to alleviate immediate downside pressure. Kiwi Dollar. So the New Zealand dollar is pushed up to its own 2017 high around 74.59 thus far. This takes the market just shy of a critical 2016 peak, which comes in at 74.85. Overall, this is a market that has been very well capped into rallies up towards the 75 handle, and so despite this impressive run in 2017, there is evidence now, given the resistance up around 75 and ahead of 75, and given some extended daily studies, that we do see at least at a minimum some form of a short-term healthy corrective decline in the sessions ahead. SPX 500. The S&P 500 traded up to another record high in the previous week, and the market does look poised to potentially continue to extend its run until we see some form of a significant bearish reversal. The trend here has been quite intense over the past several years, and we would now need to see a breakdown ultimately back below 2400 to take the immediate pressure off the top side and suggest that the market is putting in potentially some form of a major top. Until then, setbacks in this market continue to be very well supported on shallow dips, and so we can expect the same again until the market drops back below 2400. Gold. So gold has proven just how well supported it's been on dips. The market over the past several months has been supported on dips down towards now the 1200 area. This most recent dip that we saw into July was supported ahead of 1200 again, opening the door for this resumption of gains back above 1250 thus far. This puts the pressure back on the top side, firmly back on the top side, and opens the door for a retest of the 2017 peak just shy of 1300. Only back below 1200 in this market would compromise what is a more constructive outlook for gold.